Okay, let's dive right into this explainer. We're going to decode the hidden math behind active trading versus passive investing to see what actually builds wealth. You know, day trading is practically inescapable in retail finance marketing, right? And hey, the action feels incredible. But today, we are stripping away the hype. We're looking at the undeniable, cold, hard mathematics of what happens to your money over a lifetime.
So if three friends invest the exact same amount of money for 30 years, who retires the richest? To figure this out, we're going to follow three completely distinct strategies over a 3-decade journey. And spoiler alert, the winner is almost certainly not who you'd bet on. I mean, we've all seen the flashy screenshots of massive overnight wins, but what actually happens when you run those strategies through the relentless reality of a 30-year timeline? Let's meet our test subjects.
Section 1. The setup. 3 strategies, 1 starting line.
We're starting on a completely even playing field here. All 3 guys are 30 years old, they make 75 grand a year, live in the same city, and have the exact same goal, to retire comfortably at 60. They each invest $1,000 a month, but their approaches, totally different. Tyler, well, he attacks the market daily. He's glued to his screen before the opening bell, hunting for those moves everyone else misses. Then you have Greg. Greg swings with the trends. He's not staring at charts all day, but he checks the most evenings and trades several times a month. And then there's Ryan. Ryan just buys one low-cost S&P 500 index fund every single month, closes the app, and does absolutely nothing else. To Tyler, Ryan's strategy looks like leaving money on the table.
Section 2. The mirage. When winning is just an illusion.
Now, for the first couple of years, Tyler looks like the absolute genius of the group. He's constantly posting screenshots of hot streaks to the group chat, while Ryan's account is, well, it's completely boring. Zero drama. Tyler is 100% convinced his active strategy is vastly superior. But as they say, feelings and math are 2 very different things. Feeling like a winner from a few hot trades is really just an illusion masking the actual math. Tyler has this monster year that totally validates him. But what he doesn't realize, every winning trade he closes is secretly setting him up for a massive fall. The mirage is forming, and he just doesn't see it yet.
Section 3. The hidden math. 3 forces working against you. See, Tyler assumes his good years are totally repeatable, but he's completely blind to the hidden math of active trading, stuff Wall Street has understood for decades. And trust me, his trading app is definitely not going to warn him about this. He's fighting 3 relentless forces every single day: the tax wrecking ball, the constant friction of fees, and brutal statistical underperformance. The market doesn't even have to beat Tyler. His own strategy is literally doing the job for free. Let's break down exactly how these forces eat away at his wealth.
First up, the tax wrecking ball. Because Tyler holds his trades for less than a year, every single win is hit by this brutal tax reality: short-term capital gains. He is handing 22% straight to the IRS before that money can even start to compound. When Ryan, our index investor, holds for decades, his money just sits there compounding, totally untouched. But Tyler, he's forcibly handing over nearly 1/5 of his profits every single April.
And on top of the taxes, turning his account over constantly means he loses roughly 2% of his money to the quiet friction of spreads, slippage, and fees before making a single dollar of profit. I mean, Tyler might turn his entire account over 20 times in a single year. A few cents lost on every trade doesn't seem like much in the heat of the moment, but compounded over decades, that is a massive leak in his financial boat.
Now, we're actually going to give Tyler a massive advantage here. We're going to assume he's in the incredibly rare minority of day traders who actually makes money, unlike the 80 to 97% who end up underwater. Studies tracking day traders over decades find that fewer than 1% earn reliable profits after costs. But let's pretend Tyler is one of the lucky ones. As we're about to see, even this wildly optimistic version doesn't end well for him.
And what about Greg? Well, while Greg's calmer swing trading suffers way less friction because he isn't trading as frantically as Tyler, he is still stuck paying that massive 22% short-term tax drag on his gains. Greg thinks he's found the smart, sensible middle ground, and yeah, he bleeds less than Tyler, sure, but he is still bleeding. He's basically the cautionary tale that simply looks responsible.
Section 4. 30 years later. The cruel reality of compounding.
So, let's fast forward and see how the tiny leaks in Tyler and Greg's strategies compound over 3 decades. Remember, all 3 men put in the exact same $360,000 over this time frame. Watch how this gap quietly opens up. At year 5, they're relatively close, and Tyler definitely still has the best stories at the bar. But by year 15, Ryan is really pulling away. By year 20, Ryan has more than double what Tyler built. And by year 25,
The boring index investor who literally never checks his app is ahead by nearly $700,000. And the crazy part is, Tyler doesn't even realize how far behind he is because he's only comparing his portfolio to last month, not to Ryan.
Then we get the jaw-dropping climax at age 60. Look at these 30-year final balances. Ryan finishes with nearly $1.8 million, beating our successful day trader, Tyler, by over $960,000. Even Greg, the responsible swing trader, falls short by almost $1 million. Ryan wins on taxes, he wins on friction, and he wins on the undeniable historical record.
Section 5. The ultimate cost. The one currency you can't earn back.
But here's the thing. Tyler didn't just miss out on over $1 million in potential wealth, he paid an ultimate, completely unrecoverable cost. We've measured everything in dollars so far, but let's measure it in time. 60,000. That staggering number is the 60,000 hours Tyler lost staring at charts. That's 2,000 hours a year over 30 years, literally an entire second full-time career. Greg, he spent about 10,000 hours. Ryan spent roughly 3 weeks total managing his money over those entire 30 years. Think about that. The man who worked a second, deeply stressful career finished dead last, and the man who spent 3 weeks finished first, with over $1 million more.
Section 6. The actionable moral. The blueprint for wealth. So what should you actually take away from this explainer if you want to avoid Tyler's fate and, really build wealth? How do we apply this undeniable math to your own portfolio? Well, here's a highly effective rule of thumb. If you have a genuine urge to trade, because let's be honest, the psychological pull of being in control is a real human need, wall it off. Keep 95% of your money locked away in boring, low-cost index funds. That's your core wealth engine. Then take a maximum 5% slice of your portfolio and use that as your casino to scratch the trading edge. That way, you're not risking your entire future. By following these simple steps, building core wealth in index funds, walling off a max 5% for trading, and measuring your returns honestly against the index, you minimize your taxes, you completely eliminate friction on the bulk of your money, and you ensure that your desire for action never destroys your financial future. And here's a quick pro tip. If you are going to use that 5% for active trading, do it inside a Roth IRA. That way, those short-term gains aren't taxed at all.
Always remember the golden rule. The market doesn't pay you for effort, it pays you for patience. The trap is mistaking activity for progress. Tyler genuinely felt like he was winning every single week, but that feeling cost him a fortune and a literal second lifetime of hours. It is just so incredibly easy to mistake stressful, frantic activity for actual genuine progress.
Now, we've clearly seen how powerful the broad index is, but it begs a pretty fascinating question. What if one of them skipped the index entirely and just bought a single great company 30 years ago and never sold? Could that change the math entirely? Imagine buying one stock in 1995 and simply forgetting about it. That is a completely different story, with math that might be the most surprising of all. Something to think about. Until next time, stay curious and keep learning.